It's December 2022, and I'm here once again with former fund manager and investment analyst Ken Baksh to give us his take on markets, stocks, indices, the economy, you name it. It's all here. Hello, Ken. It's good to speak to you again.
Hi, Alan. Good to see you. I can't believe it's December already.
Where's the year gone? It's ridiculous, isn't it? And of course, we're speaking on a Monday, the day after England beat Senegal in the World Cup. So it's been a great weekend. But I should say at the start, we're going to be discussing a number of stock ideas. And I will say at the outset, this is not an inducement to buy. You should do your own research, and we may or may not have positions in the stocks mentioned. So we've said that now. I will also say here as well, I'm bringing this screen up here. Ken publishes his views on markets every day and on the macro issues, and he has many stock thoughts and trading ideas. We're going to be looking at some of those later on, and also seeing how the ones we've discussed so far have performed. Now, the plan is Ken is going to be launching a subscription service for members in the new year. If you're interested in joining the distribution list, you'd like to take advantage of launch offers and so on, please go to the address you see on the screen, branduk.net/contact, and you'll see a box where you can submit your details. So on with the show, as they say. So Ken, first of all, we've seen huge movements again, huge developments since we spoke in November. Can you just summarize the macro picture for us? What's happened? What are the global investment indications? And also, how have asset classes been moving over the period?
Yeah, sure, Alan. Well, starting with the global growth picture, it's if anything, it's got a bit worse than when we last spoke, and it wasn't good then, if you remember. Just in terms of numbers, the growth for this year globally looks like it's going to be about 2 or 3%. We were looking at 5 or 6% at the beginning of this year. Going through the major zones, the US is weakening as expected, although the job market is remaining reasonably perky, as we saw from last Friday's figures. Europe is technically in a recession now, and of course they have this added complication of the gas squeeze across the continent, and the various measures to help that are being argued out at this moment. Japan always tending to do its own thing, but the figures there show the third quarter slowdown after a couple of good quarters. 2.6% down, that wasn't expected. One area that stayed reasonably firm relative to expectations was other Far East, and China, which I'll talk to as a separate subject in a minute. Estimates were reduced from 5 to 3.5 after the conference just a couple of weeks ago. But you've all heard the varying stories about COVID and the gradual unwinding of procedures. We'll go into that and the implications, in fact, for one of our investment ideas. Inflation is still an issue. UK, we're talking about 10%. Europe, we're talking about 10%. America, 7%. And even Japan, we just mentioned, about 3.5%. All higher than expected, all higher than central bank forecasts. However, if you were to look at the most recent monthly figures, there are some signs, particularly in America and Europe, that fuel prices have been coming off, and they're coming off further. Some of the food price inflation is easing a little bit. And of course, when we get to spring next year, you have this base effect whereby the comparison of figures next February, March with February, March 2022 won't look as bad. Now, we mustn't bank everything on 1 month's figures, but it could be that some of those super inflationary figures are starting to ease a bit.
That's good
Where
to
does
know.
this leave interest rates? Well, all the central banks now, almost as if they're piggybacking on each other, are saying we want to get inflation out of the system. 2% is our central bank objective. We will do what is necessary. But perhaps because of those inflationary changes I just indicated, instead of 50 basis point increases, which is still a lot when you're talking about small base, instead of 75 basis point, there might be 50 basis points. So perhaps straw in the wind, if you like. So that's the bigger picture: growth, inflation, interest rates.
Okay. So if we're peaking, then is it too early to be cautiously optimistic for prospects early in 2023?
Well, it's interesting what perhaps the last 2 months market performance has given us just a taste of. Since September, end of the third quarter, to the end of November last week, equity markets have had quite a bounce, and particularly the more speculative and higher beta markets. Here talking about China, about Europe, continental Europe. Part of this maybe this expectation that inflation may be starting to wane. Interest rates, although still going up, are not going up as quickly as earlier indicated. But having said that, we must remember when you're talking about individuals' balance sheets and companies, we're still talking about 4 or 5% interest rates, short-term interest rates, compared with 1%, a year ago. And that is still a shock for a few people and companies. In the UK specific case, of course, they got even higher at the point of the Truss Kwarteng mini budget, up to 5, even more. Long bonds have stabilized. So that's an encouraging move. And over that same period, currencies have been a bit more volatile, but the dollar seems to have started coming off the top, which is helping sentiment in one or two markets. So you've had 2 months, good markets, despite the headline bad economies. December, traditionally Christmas, Santa Claus rally, whatever. I would caution reading too much into it this year because of this gain we've had already. But I can see a cause for maybe some optimism next year if you get this combination of interest rates not rising so quickly. Maybe the COVID situation in China allows their economy to open up more. Maybe the Russia-Ukraine situation isn't such a headline. So that's where we stand there, Alan.
Okay, that's interesting. So you've indicated, Ken, that we could be cautiously optimistic going forward. What sort of strategy would you be looking at given that backdrop?
Right. Well, looking at the major areas and bearing in mind what I've just said about interest rates and growth, we have to remember equities don't like rising interest rates and falling earnings. A number of companies in the UK and the US, for instance, are facing that weaker earnings trajectory. And this is coming primarily because consumer expenditure is weakening, and yet their costs, labor costs, material costs, are still rising. Margin squeeze, profits warnings. So although we could say the macro backdrop for equities might be improving if those interest rates come down, we want to avoid areas which could have surprises in earnings shocks, or conversely, look for companies with strong balance sheets, earnings growth, in some cases dividend payments, or geographic regions which give you those attributes. Geographically, that would take me to the Far East, for instance.
Yeah.
Economic growth has stayed reasonably robust. Inflation is not an issue. They're talking about 4 or 5% compared with 9 or 10%, say in America, in the UK and Europe. And we're not getting a lot of earnings, profits downgrades. So some areas to overweight. Japan is low on PEs. They're not having the same amount of earnings disappointment, and they're paying some interesting yields now in Japan. America, a bit of caution. We've seen a lot of the big tech companies who've already had disastrous years laying off thousands of workers, and that's not a good sign going forward. So selectivity at stock level and at country level.
Okay. So talking about countries, let's come closer to home then, back to the UK. Number of developments and changes over the last 3 to 4 weeks since we last spoke. What does it look like to you at the moment, Ken?
Well, the looking at historic data, the situation is weak. Consumer sentiment indicators, which take us right up to late November, so only a week or so ago, show levels not seen for 30 or 40 years. And this is mainly the consumer and the squeeze that we all know about, and was, if you like, strengthened by the autumn statement that Jeremy Hunt had to deliver to keep international credibility. Spending power is weak. And the consumers, remember, 60% of the economy. Exports aren't growing. Governments aren't spending. Insolvency data shows that more companies, particularly medium-sized companies, are going bankrupt. The employment situation is still reasonably okay, but signs of layoffs coming unfortunately, this pre-Christmas period. And on the labour theme, of course, we're all going to be facing a number of strikes, particularly in the public sector, where some of these guys have been offered 1 or 2%, and they see headline inflation of 10%. So the growth figure, inflation figure, deficit figure, public deficit, current deficit, insolvencies are still quite depressing. And the Bank of England, the Treasury, and indeed the OECD have all said we expect 1 or 2 years of negligible growth in the UK. So we can't paint a good recovery there yet. So that's the economy.
Mm-hmm. Yes. Okay. Well, of course, within that, there are numerous companies that you and I have been discussing over the past few months. And you're clearly a very seasoned stock picker, Ken, because despite the gloom and doom and the volatility within the markets, you've actually delivered a pretty good return. So I'm going to bring up the chart now that shows just how well these stocks have done since we started the series of interviews here. So can you talk us through what we're looking at here? These, of course, we can see lots of green numerals on the right, which is always positive. It means that the stocks in question have risen. So can you take us through this, Ken, please?
Yes, I'd caution first to everybody about becoming too short term. These ideas were sort of medium time portfolio ideas, and in fact, I'd still recommend these as stocks of interest if you were building a portfolio. And just running through the news flow, we've had Legal and General confidence statement. They've come through the pensions issue well. They're gaining new business, balance sheet strong, putting up the dividend. Smith and Nephew, remember, this is the orthopedic, artificial hips, knees, wound healing. Again, they're catching up, a bit of a backlog of NHS procedures, and also home use. Again, confidence statement. Begbie's confident for the wrong reason, maybe, but insolvency is rising. They're issuing another, I believe they're issuing another positive statement in a couple of weeks. Still very keen on this one as a sort of counter economy play. UK wind, this is the wind farm. As I was expecting, the government action on windfall taxes and capping of prices wasn't as draconian as it could have been. And there was a sort of relief in that whole sector when the autumn statement was released. So it's still a good renewable theme with a yield, and one of the uncertainties is out in the open now. We know what the government's doing. So that was the first four. The second four, Whitbread, there hasn't been much news on the stock price. This is the one, if you remember, that's dependent on a lot staycation, staying at Premier Inns, a bit of a consumer travel play. I might be too optimistic and then people give up holidays altogether. I don't think that is the case. And I still think there'll be a lot of people traveling around the UK and maybe catch up. They're one of the beneficiaries. It's still strongly on the list. FIP, Frontier IP. As timing would go, I'm actually going to visit this company tomorrow. They're putting on a show at Duxford, near the Imperial War Museum, of a number of their subsidiary companies. If you remember, this is like a holding company of other tech companies in a number of areas, and they'll be running through about 8 or 10 of these. The stock's moved since we mentioned it, and I believe tomorrow won't disappoint. So I'm quite excited about listening to the companies, kicking the tires, and I expect this one will stay on the list for a while. We're still trading a bit below asset value. Enquest, this was the bond. Fixed interest, basically. Capital price doesn't do much, but you're getting about a 10% income every year. And as bonds work, you get accrued income every month. So if you think of this stock, it hasn't done much capital terms, but you've had 2 months of income of about 1%. So you've had roughly a 2% return in income, capital the same. And the reason we bought this was for the income return. And Georgian investments, very well. We captured this one at the right time. Results were good. Economic news from that area is excellent. Discount has closed from 66% to 59% as I talk. It's still very attractive, though, as a specialist emerging market play.
Excellent. So we're in the green on all these stocks, which is in these markets, I think, no mean achievement, and I think well worth noting, and certainly be interested when we talk next month, Ken, to find out how your visit to Frontier IP went. But of course, going forward, Ken is going to be bringing us new actionable stock ideas as we go forward. This is early days with our interview here, but we are looking at other ways of exploring these. So do watch this space. Meanwhile, there are 4 new stocks to look at this month, and I'm bringing the first one up now, which is, of course, Chemring. Ken, can you talk us through Chemring, please?
Chemring, yeah. They call themselves a technology solutions company. I would put it in the category of a defense company. Based down near Southampton, they have 2 major divisions. One, sensors and information, and one, countermeasures and energetics. The first division, sensors and information, it's basically hazard detection. That could be biological, it could be weapons, armaments related, it could be data related. All these that to help the forces detect dangers, whatever sort. They work for 50 foreign governments, mainly, obviously, the national defense areas. Business growing very strongly. The other area, countermeasures energetics, this was part of their original business, whereby planes would release flares or decoys to attract heat-seeking missiles. This again, very specialist area. They're very good at it, and contracts all over the world. And they've got major manufacturing in the UK, also in America and Australia. So a defence play, and the UK defence industry has unfortunately shrunk over the years, but this is one of the specialist players left, and recommend the business. Balance sheet is strong, conservatively managed. They don't overgear. And from time to time, it comes up as a takeover target. But the government, the UK government, seems to have send a mixed message regarding takeover of defence, what counts as strategic interest or what doesn't. But the point is, this is good value, and it is of interest either to UK companies or UK individuals, institutions, or perhaps overseas predators. So that's Chemring.
Okay, so moving on then, we're looking at Lloyds preference shares now. Can you talk us through these, please, Ken?
Yeah, I mentioned Enquest earlier as trying to give a broad list of ideas. This is actually a preference share, and for those who want to Google preference share, you'll see it occurs in a company's capital structure as somewhere between ordinary shares and bonds. So it's not as volatile or as risky as an ordinary share. It's not quite as secure as a company bond. But this preference share is issued by Lloyds Bank, which itself is actually in a very strong position. Following the 2008-2010 financial crisis, all the banks were asked to massively improve their liquidity, their solvency. So the banks' ratios are very strong. And in fact, the ordinary share is very strong.
Yeah.
Preference share is one step more secure than that even. It's priced at about 132, this preference share. It pays a fixed coupon every year of 9 5/8%. So when you divide one by the other, you come to a figure of 7% annual yield. So it pays out income in January and July, I think it is, every year. It's irredeemable, hasn't got a fixed date. So it's an income play, a bit like the Enquest we spoke about. Pays you income. Capital, well, it has been reasonably volatile. You could expect some appreciation on the capital as well. But the main point in holding it is this 7% yield if you buy it at the moment.
Excellent, excellent. Okay, so we're moving on to Asia Dragon Trust now. This is, of course, with a focus in Asia, in the Asia Pacific region. Can you take us through this, please, Ken?
Yeah, this was actually, it's turned out to be rather timely for two reasons. I visited the company last week, and the China sentiment seems to be turning. You put those two together, and this, if you want to take the risk, this is a prime play. It's an investment trust structure, so a pooled fund where the assets can trade at a price above or below that asset value. If you add together its China, Hong Kong, Taiwan, etc. exposure, it's over 50%, which is quite high. It holds, I think it's 43 companies, so you're getting pooled exposure. The other areas include India, Indonesia, Malaysia, Philippines. But I look at it partly as a China play at the moment, and you're not taking the risk of buying a one China stock. You're getting Chinese exposure across technology, consumer area, financial area. The trust is on a 12% discount. It was this morning, which I don't think is going to last long. So if you're looking at the area, and I would look at the area, and if you want to take more of a stance on China, this would be the vehicle. watch the tea leaves carefully as to what Z does and says about COVID, because we are getting mixed messages every day.
Yes, we
but
are.
My sense is, and there's a question of pride and face here in the usual Chinese style, that they will gradually ease, and this will be one of the beneficiaries.
Super. Okay, so finally for this week, then or this month, we have legal and general cybersecurity ETF. Sounds interesting. Interesting chart there too. Can you take us through this, please, Ken?
Yeah, I mentioned earlier the weakness in NASDAQ this year, and some high-profile names come down to earth quite quickly, including Meta, or whatever, Facebook, as it used to be called, Google, Netflix, Amazon, Apple to a certain extent. Now, some of these, the businesses, some of them were overpriced to start with, but the business models are starting to be questioned. I give two examples there. Facebook, Meta, is pinning his hopes, young Zuckerberg, on the metaverse. Wearing these fancy masks, seeing everything in another dimension, may or may not pay off. My view is it probably won't, but that's the view the company's taken. It's $1 billion company. Other companies are suffering from a digital advertising slowdown, which is partly a function of the economic weakness I've been talking about. But there's one area which grows in fundamental terms and continues to grow, and it's cyber security. Wherever we look, our own accounts, spam on the bank, spam on Black Friday, companies, governments being targeted by hackers from, you name it, Iran, Korea, China, Russia, everywhere. Cybersecurity is growing, and it has to grow. This is an ETF, which stands for Exchange Traded Fund. So it's a pooled vehicle containing 30 or 40 cybersecurity companies. Names such as Norton or Cisco or Darktrace. These are companies which, if you're in the tech area, you're familiar with. Their business is growing well. These companies haven't had profit warnings by and large, and most companies are dedicating a director to the area of cybersecurity. And it's happening in the finance industry, it's happening in state departments, everywhere. So if you want long-term pooled exposure to cybersecurity, I'd recommend this ETF as a way of playing it. Code ISPY, denominated in dollars, very small spread and easily traded. So that's long-term cybersecurity play, Alan.
Superb. So there we go. There are 4 more ideas for you there from Ken. Remember also, of course, the ideas we spoke about in October and November are still doing well, and some of those are still arguably undervalued. So if you want to subscribe to our service, here are the details again that we spoke about at the start. Please submit your details to branduk.net/contact. There are boxes there to complete, and you can send us your details, and we'll put you in touch with Ken, and you can avail yourself of Ken's ongoing service. So it just remains for me to say, Ken, thank you very much once again. Awful lot of work and research went into that. And also to all our viewers, have a wonderful Christmas and a profitable, peaceful and healthy 2023.
Here, I can echo those sentiments. Guys, goodbye, everybody.